The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Hello everybody, this is Coach D with TackleTrading.com, here to give you your market update and recap. Starting out here with the E-mini S&P Future Standard & Poor Index trading down pretty heavy today, right into the close on typical volume. If you get a look at the volume in here, that's kind of right. If you were to draw an average across there, ballpark, that's pretty typical. And kind of coming off of last week's big rally candlestick right here. On Friday, it closed right at the high on just slightly above average volume. And then Monday, we got the doji, and you'll notice the dip in the volume right here for the doji, and that, that's a classic reversal signal. Now, if we were to take a measurement from the start of the wave, the very, very top, down to the bottom of that candlestick low, the very, very bottom, and measure the Fibonacci retracements, you're going to see 38.2% right in here, and then this is going to be right at about 50% even. And then, the deeper retracement, 61.8%, is going to be up in here. And that's typically where you will see retracements, off of a big motive wave down, corrective wave back up. It'll usually come off of one of those resistance points. Now, the shallower the retracement, meaning a 38.2% retracement, usually will give a better run than, say, a 61.8% retracement. That usually gives a smaller run. So when you see that retracement, 50% would be the average. That's a pretty good sign. So let's actually just take that and actually go do the measurement. We'll use the Fibonacci retracement, and we'll measure that up from the top down to the bottom. And you can see that 50%, wow, it almost just to the penny, just right off that and then down. Now I can also see in here a very, very let's go ahead and erase that there. Can also see a very clean intraday trend line here on the daily chart. And one of the tricks to becoming a good technician is learning how to read multiple time frames, but actually being able to peer down, below the hood just by looking at it. I can see candlestick low here, 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 and here. And we can connect those dots for a pretty clean trend. And because it hasn't violated that trend, it's not technically a full-blown reversal. This is still making a higher high and a higher low and a higher high, and if it makes a higher low, it could continue up. Now, the overall context for this is a bearish flag pattern. So there's the bearish rundown, motive wave down, and this is called the flag. And so you can kind of picture yourself, the stars and stripes in there, waving upside down. That's where the bear flag, the visual from the flag pattern comes. Here's an example of a bear pennant, and it's going to concede. And what we're looking for, one of the keys for confirmation, when you really want to, open up the bearish directional trade, is when you see the violation and that close. So we got to close below that low and that violates that trend line. That'd be a very good sign. And if you want to get a good trigger on that, you can take it intraday. And here's here's an intraday 30-minute time frame. You can actually see, now we've got a good, let's go intraday. We'll get a little bit of history here. We'll go grab the last 20 days and 30 minutes or so. And you can see kind of in the context here, here is your all-time low, but you can see a pretty clean trend channel in here connecting those lows. That's connecting 1, 2, 3, 4, 5, 6, 6 lows. And so if it violates that, and one of the keys is closes below. We want to see it closing below that line for reversal. Now here you can see an M for murder, a double top, or you can even look in here and see a head. Whoops, let's zoom back out on that. Left shoulder, head, right shoulder, excuse me, and a kiss goodbye. And you've got your general violation to the downside. Now that's a micro pattern on a 30-minute time frame, but that's where we're looking at. Now we can back it out to a weekly perspective, and we can see where the the market has broken through the key support zone. And really in here we're seeing the same general context of, the big drop, the retracement back up, that's a dark cloud cover from the weekly perspective. Would be realistic to expect this to drop, and I'm thinking 1800 would be a reasonable near-term target without upsetting the market too much. Now, for projecting and identifying a target, using a big fat number like 1800, which is about where that 200 period moving average will come in there, and it's going to coincide with the old support resistance neighborhood. If you look at it here, you can kind of see 1800 ballpark in the past was, known support, a little bit of resistance, close enough to those ballparks where you can see that. But if you want to do a Fibonacci extension or a projection to the downside, you use the extension tool and you measure the same wave. So the way we're going to do this is we're going to measure from the top of that wave down to the bottom. And then we consider this, we're making an assumption that that's the starting point of resistance. And if it violates here, the beginning of the next wave down. So this would be kind of your down wave. And I would say based off of this being a kind of a double top here, breaking support, that would be my first wave down for an Elliott wave count. That'd be an Elliott wave 1. So you got a 1, 2, 3, 4, 5 there, and then an ABC. So that's a 2. So that would make this one a 3, which you see a 1, 2, 3, 4, 5 in there. And there's 5 waves, and then this would be ABC. So that would be number 3. This would be a number 4, and then we'd expect a 5, which would be about the same size. Let me clean that up. So let's kind of clean that 1, 2, 3, 4, and usually fifth wave is about the same size as the first wave, which would be kind of a good ballpark for that. But let's just kind of see how that measurement works out. So you measure from the top down to the bottom, and then you measure your retracement back up. And there you got 1805 would be the 50%. 61.8% puts you down at 1773. So there's a ballpark. Now you can also measure the seed wave, the first wave, and you can measure that one, and you can pull the retracement back up to where it starts. And here you'll notice you got some coinciding going on there, or you can actually pull that back up to your starting point and use the measurement in that ballpark. And so this is where you get what's called a Fibonacci cluster, where two of those lines measured up, they wind up in the same ballpark. So down there around 1775-ish is where you see the 261.8 and the 61.8 lining up in the same zip code. And so, with hand grenades and horseshoes, close counts, you get into that same type of ballpark. It would also be about the same as a 200% type move. Would put you in that exact same ballpark. So that's just kind of some fun with Fibonacci's. But across the board, let's look at the Nasdaq real quick. NQ. Go reset the scale there, auto, bam. And very much the same bearish flag pattern. Typical volume on that. So exact same story. Let's look at the Dow, E-mini S&P, same pattern, same story. Very, very clean looking chart. Let's look at the Russell 2000 TF. Same pattern, same setup. A little bit more shallow on the flagpole, the flag part of that, where you can see that this is more like a 38.2% retracement. And again, we need to see it violate down in order to get that confirmation. We can look at the dollar index real quick. And watching the dollar index, I'm actually kind of bullish on the dollar, especially when compared to the other currencies. You got some of the other major currencies getting pretty weak on their interest rate. Japan looks like they're going negative, and Europe's not far behind. You got that trend line in here, and you got the known $100 resistance level. So you're kind of looking for an ascending triangle. So I'd expect that. And if we break 100, I'm definitely going bullish, but watch for a reversal pattern down in here on the dollar index. And let's take a quick look at crude light. Nailed the bearish trade on crude oil and the USO this week if you go check out the stock report. Very, very clean support resistance. Doji signal candle confirmation. We're 2 days into the run, violation of the trend. We could expect that to probably continue to trade down towards 28, 27. You'd probably count here in this case similar wave length ballparks. You can kind of average out a potential average yield on those, and I'd probably expect that on average you'd say there's 41, 48. You're talking about a 7-point run kind of ballpark. So from 34, 7 points down is going to put you down towards, so you're looking around 27 ballpark on the target on that. And of course, would be helpful to drop back and look at the weekly chart if you need to gain some perspective. We're really dealing with 20-year lows here. $30 is a big number for it. So if it breaks 30, we won't be surprised to see it heading much lower than that. Not too bad there on crude light. Let's take a quick look at the gold contract, GC. And from a weekly perspective, still in a downtrend. We talked about that being near the top of the resistance zone. So watch out. But otherwise, I think I like gold in general, kind of showing some bullishness. But you see there's a rising wedge pattern in here, which is a warning, slowdown. Here comes that 200 period moving average in the downward trend zone. So look for a bit of a correction in here, and that creates a buying opportunity down here towards 1090. We like that for a buying opportunity. And then let's take a look at the SI for silver. Not as much a recovery. In here you got triple bottom and some ascending, lows, higher lows in here, and it's poked its head up above resistance. Yeah, but if precious metals fail, then I probably wouldn't be surprised to see this drop down again and watch to see if it can set a higher low at 14. That's kind of your general look across the board. Let's take a quick look at the volatility index. And for the volatility index here, we're at 22.5. And if the market starts to drop, you can expect the VIX to pop. And so that's the negative correlation on that. And, if the market does drop again, expect the VIX to pop. And I'd probably be ballparking it towards 30. And if it gets up above 26, your option premiums become very, very good for selling options. And that's where you look to go sell your covered calls, out of the money, way out of the money naked puts on the fundamentally strong stuff that has support zones to protect it. Hopefully this has been very educational and informative for you, as well as giving you a good update on the market. This is Coach D with TackleTrading.com. We will see you all in the clubhouse.
Isn't it time you got off the sidelines and tackled trading? Join our online community of active traders where we make it happen every day. Stocks, options, futures, and Forex at www.tackletrading.com. Get in the game.